We detected an unusual trade worth $50 million on DUK Energy stock, ticker symbol DUK. And what's also very unusual about this is that DUK Energy reports earnings in a few weeks on February 13th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying DUK Energy before earnings or bearish and selling DUK Energy. Because as we all know, the rich have more access to information, including leaked insider information such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into the data as usual. As we can see here on the options time and sales tape, there were 2,000 contracts being traded at the same time. But notice that there were also multiple trades for the same options also being traded at about the same time as well. For these April 17 options at the 100 strike puts and the 115 strike calls. And when we take a deeper look at the option chain for these unusual options that expired April 17, we can see here that at the 100 strike puts, we have a total of 5,000 contracts being traded at the volume, and also at the 115 strike calls, 5,000 as well. And based on our analysis, they were selling the 100 strike puts to open and buying the 115 strike calls to open. And so when we analyze this trade, we can see here on the risk profile that as the share price goes up, which is represented here on the x-axis, and DUK Energy stock is currently trading here, this trade becomes more positive profitable. And if it goes down, it becomes more negative loss, because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. And what's also interesting about this trade is that it is hedged all the way to the $100 share price, and that is why the blue line, which represents the expiration date, is flat, so that the losses are limited, because this wealthy investor sold the 100 strike puts, which means they are willing to own 100 shares at this share price. And so we multiply 100 shares by the strike price, which is 100, and we get $10,000 of buying power required to put on one of these contracts. And since we know there was about 5,000 contracts, we multiply that out and we get a total trade that required $50 million. But keep in mind, earnings is coming up, and so this is a higher risk trade in comparison to the trades that we share on our website. If you want lower risk, higher chance of profit trades, then make sure to go to our website.
Visit www.unusualoption.com to join our membership and start your journey to a financial success with a partner you can trust.
We will put a link to our website at the top here, where you can gain access to more of these trades, but with stronger data analysis. Because not all of these unusual trades will be profitable. Some of these will be a loss. But as long as we diversify with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. Now, with that said, we still traded this, but we use position sizing to manage our risk. You can see here our position, POS stands for position, green means buy, where we bought these 115 strike calls. And when you analyze this trade, you can see here that this is also a long bullish trade. As the share price goes up, this becomes more positive profitable. We did not sell those 100 strike puts because they require a lot more capital, 10,000 per contract, whereas these call options only cost $250 each. And so we can use position sizing to manage our risk, because we put most of our capital in the higher probability of profit trades that have a lower risk. You can see here on this trade, there is a negative theta risk here which means these options will decay in value every day. And that is why the purple line, which represents the current date, drops down lower to the blue line, which represents expiration date. And the break even shifts up all the way here where the stock needs to trade for these options to be profitable at about $117.52, even though these call options are at the 115 strike price because they decay in value. And so we typically set up our own option strategies to reduce this theta risk. But for trades that have a higher risk, such as this one here with earnings coming up, we enter very simple trades and simply just use position sizing to manage the risk. If you are interested in better trade ideas and strategies, then make sure to go to our website. We'll put a link at the top here where you can learn more about these strategies to reduce risk while increasing the chance of profit. Let us know in the comments below. Do you think Duke Energy will go up after earnings, or will it crash down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.